Good morning.
Good morning.
Yes, Sahil,
Hello,
good
sir.
morning. Yeah.
Yeah, morning.
How many are there? Okay. I think can wait another 2 minutes?
Sure, sir.
Okay. Because I think people are joining.
Yes, sir. Sure.
Uh, so in the meantime, I request all the members to type in their name as well as the organization affiliation in the chat box, and we'll start after in a couple of minutes. Thank you.
दो लोगों का उसमें नेट है ना आरटीजीएस, वो दोनों को ड्रॉप करके उसका फिर से आईएफटी में एंट्री करिए, आईएफटी खाता खोल के। हाँ, और फिर से एंट्री करना पड़ेगा तब 3 का जो आईएफटी है ये
इसमें वो ज्वाइन कर पा
Yeah. Well, good morning once again to all of you. Good morning, Sadaf Sab. Thank you for joining. Good morning, Sahil from CRIF Highmark. Thank you for joining and welcome each one of you for this today's discussion, today's meeting. Basically, we are trying to understand about the Grameen credit score developed by the CRIF Highmark. As you all know that in the last budget, the Finance Minister Nirmala Sitharaman ji had come out with the idea of Grameen credit score, basically to make the especially the people in the rural areas become more eligible for the loan facilities. So trying to get a overall picture about their credit history or credit background, and which will help in going ahead with a fresh lending, so that they would be able to get loans much more easier way. So this is what my understanding is. Of course, I'm sure Sahil will be able to give us more ideas on that. So on that announcement, after the announcement, I think RBI had invited all the three credit bureaus and advised them to develop a model, and each one was asked to develop the model. So accordingly, I think Civil, TransUnion, then Equifax as well as CRIF, all the three of them have developed their own models for the Grameen credit score rating. So we had one such presentation. We had a presentation earlier by the CIBIL, TransUnion CIBIL, and today we will be hearing from the CRIF Highmark. So I think without wasting time, we'll go straight to Sahil. Sahil, over to you. Kindly give your model and let's understand how you are working out this particular Grameen credit score. Thank you.
Thank you very much, sir, for the quick introduction, and good morning, everyone. Thank you for your time to join this webinar. So, as sir mentioned about the Grameen scores background, again, just a few points to add regarding why there was a need felt to announce for an announcement in the union budget by Honorable Finance Minister to have a separate scoring model for rural borrowers. So, as we all are aware, rural borrowers have specific lending or credit patterns. They have specific patterns in their sources of income. There is seasonality in their sources of income, and so on. And therefore, a generic credit score, the consumer score that we already have, may not be sufficient enough to appropriately evaluate the risk inherent with rural borrowers. So, just to add that that was the basic need that was felt by the government and thereby by RBI, that there should be a separate model to fairly evaluate the Grameen borrowers or rural borrowers based on their lending patterns, their financial patterns, their income sources, and their repayment behavior, which may differ from the people in urban areas. So, with that context, I will start presenting my screen.
Right.
Yeah. I hope my screen is visible.
Yes, yes.
Yes, sir. Thank you for the confirmation. So, CRIF has developed the Grameen credit score, which is, as I said, specifically tailored for rural borrowers. So, firstly, what is Grameen score or what is Grameen credit score? Grameen credit score is a completely new model developed by CRIF Highmark to provide the current risk view of the rural population. What does the risk view mean? Means what is, so the model considers, as we will see ahead, the model considers the repayment behavior of the rural borrowers, and it predicts what are the chances of those rural borrowers or that particular rural borrower that has been awarded a Grameen score to go 90 plus days overdue or substandard in the next 12 months after the scoring. So the Grameen score looks at the repayment behavior of the rural borrowers, and it predicts what are the chances of the borrower going default or 90 plus or substandard at least once on at least one of their trade lines or at least one of their loans up to 12 months after scoring. And it is specifically developed and tested on rural population because it is meant to be used to assess the risk inherent with rural population. As we already discussed earlier, and sir also mentioned that it was introduced in the union budget by our honorable finance minister regarding the need of a separate and more efficient and more accurate model of assessment or evaluation for the rural borrowers whose financial profiles would differ. And this development of Grameen score is also aligned with RBI circular regarding the development of Grameen score that was followed up after the announcement in union budget. To make the model robust, there are specific there is a specific mechanism or strategy that we use to develop the model, and for Grameen score as well there is a specific strategy that is being used, and that is to use multiple segments or power the model by multiple segments. So there is no one single segment or no one single algorithm to score all the Grameen or rural borrowers. There are multiple algorithms. By segments, I mean there are multiple algorithms to develop different, to score different cohorts within the rural population based on their previous repayment history. The model is developed with logistic regression, and it has precise binning and risk profiling, again specific to the rural population. And therefore, we find that the efficiency of the model and the accuracy and performance of the Grameen score model is highly precise for the rural population, and we have tested it not on one but on multiple validation samples, which we will also see during this presentation. So while the model is built on one sample, it is tested across multiple samples to check the stability of the model and the relevance of the model across different time spans. So certain basic details of the model, and after this we will also compare what are the differences and similarities of the Grameen credit score model with the existing consumer credit scoring model. So the score range is from 300 to 900, which is similar to that of the existing consumer score. The key difference here is the model is built on rural pin codes only. So only rural geography, rural borrowers have been selected to develop the model and to test the model. Within the rural borrowers, we have not restricted to any ticket size or uh, loan types or product types. We have considered all the product types, all ticket sizes that have been availed by rural borrowers. And also, we have not restricted to any credit institution type that is lending in the rural geography. So, all ticket sizes, all product types, as I mentioned, including the ones that are predominantly disbursed in the rural areas, such as tractor loans, KCC, business agri loans, MFI loans as well, have been used to develop the model. And of course, loans disbursed by all credit institutions, such as PSU banks, private banks, NBFCs, MFIs, etc., have been used to develop the model. Uh, as I said earlier, the bad definition or the prediction that the model gives or the target variable that the model gives is 90 plus DPD in the next 12 months of scoring. Now, a key question, up to how much period of repayment history does the model take into consideration to award a score to the borrower? So it takes into consideration 36 months of credit history, and that is up to 36 months. So it is not necessary that minimum 36 months of credit history should be available for the Grameen borrower. Up to 36 months of credit history maximum is considered. Even if the credit history is less than 36 months, the model still generates a score. Now, there are certain key variable categories based on which any model is developed, and those key variable categories should be highly correlating with the outcome, which is our bad definition, that is 90 plus DPD in the next 12 months of scoring. So what are those key variable categories or model development pillars of variables that we call? First is the repayment history. So like I said, 36 months of repayment history is considered to develop the model. And within repayment history, what does the model check? The model checks whether there is any presence or absence of a delinquency or any instance of overdue amount. If yes, what is the frequency and recency of the delinquency in the last 36 months? And what is the severity of delinquency in the last 36 months? By severity, I mean whether it is 5 plus days overdue, 10 plus days overdue, or simply 30 plus, 60 plus, 90 plus days overdue, and so on. And also, what is the quantum and proportion of delinquency? By quantum of delinquency, I mean what is the actual overdue amount, and by proportion of delinquency, I mean what is the ratio of the overdue amount as a percentage of the current balance and the sanctioned balance. So these types of variables are covered under the category of repayment history. The next pillar is utilization. Utilization indicates what is the proportion of current balance that is utilized from the total credit limit awarded to the borrower for revolving credit facilities. So it is usually seen that a consistent overutilization often indicates higher risk and often results into delinquencies. So the model also takes into consideration how consistently is the overutilization being observed. There could be overutilization during festive seasons or any other seasonality in the borrower's business line of business. For example, in agricultural business there are seasons during which utilization may be on the higher side because the farming activity happens as per those farming seasons or agricultural seasons. But it checks not just, it does not check for only one time spike in utilization or seasonal spikes in utilization, but consistency in overutilization is what is considered. The next key variable type or category is credit acceleration. So this indicates how quickly has a borrower acquired new loans in a short span of time. What is the number of new loans and what is the amount of new loans, the value of new loans acquired in a short span of time. Again, high credit acceleration in a short span of time often correlates highly with credit risk and is highly correlated to delinquencies observed in the future. The next type of credit variable attribute type or the development pillar is product mix. So this indicates what are the different types of products, secured and unsecured and revolving products and term loans and so on, that have been availed by the borrower. And lastly, the next the next model attribute type or pillar is vintage. Vintage indicates what is the experience of the borrower in taking up new loans and retiring those loans or repaying those loans. In simple words, it is the date, it is the duration from today's day to the first ever loan availed by the borrower in their repayment history. So this was a high level view on the model details and the variables that are used in the model. Now, what is different between, like I said earlier, we will see what is different between the consumer and the Grameen score and what is the similarity. So the only difference in the consumer and Grameen score development is the geography. Consumer score credit model includes entire set of pin codes in the country, whereas the Grameen score includes only rural pin codes. That is, it is developed only on the rural pin codes. All other parameters are the same, which means we have considered all product types in both models, that is all loan types in both models, including the ones, of course, in Grameen score, including specifically those ones that we discussed that are predominantly disbursed in the Grameen areas, and also including MFI loans. Again, the model is developed on a portfolio view. Both models are developed on portfolio view. There is a single bad definition type, which is 90 plus DPD in the next 12 months at a customer level. And the score range for both models is from 300 to 900. 300 is the highest risk score, indicating the highest probability of the borrower going 90 plus in the next 12 months. Whereas 900 is the least risk score, indicating the least probability of the borrower going 90 plus in the next 12 months of scoring. Now, there is a question that might arise, why we have considered all product types instead of only those product types that are presumed to be more Grameen in nature, such as KCC, tractor loans, business agri loans, MFI loans, and so on. So we will get the answer of that particular question on the forthcoming slides. So if you see here, we while deliberating internally during the model development and specifically on the selection of product types to develop the model, we considered three main parameters. First, the product mix of the presumed rural and urban loan types. Second, what is mentioned in the union budget announcement. And third, what is mentioned in the RBI circular. So let's look at these one by one. The first is the product mix. So we often presume that these loan types, that is Kisan credit card, tractor loans, two-wheeler loans, business loans from priority sector specifically for agricultural use, and JLG loans are mainly distributed in the rural geographies, or only disbursed in the rural geographies. So if you can see here, while the caveat is correct that they are mainly disbursed in the rural geographies, but you also see a significant presence of those loans in the urban geographies. So we can say that these products that we are assuming to be rural specifically in nature are also present in urban geographies. Now let's have a look at the other set of products which are mainly presumed to be disbursed in urban geographies only, which are credit cards, housing loan, property loan, car loan or auto loans, personal loans, business secured business loans and gold loans. Now again, if you see the disbursal percentage is higher in the urban geographies, but they are also significantly disbursed in the rural geographies. So this fact cannot be denied. So why, if we had considered only the rural product types, we would not be able to score those borrowers accurately from the rural geographies, which have also availed credit cards, housing loans, property loans, and so on that are mentioned here. Because we see a significant proportion of those loans are also disbursed in rural geographies. So this establishes a fact that no longer are presumed product types restricted to those presumed geographies. They are being disbursed across all geographies. So we should consider all product types. Next, if you have a look at the union budget announcement, the announcement again does not restrict to any product types. It calls out for accurate or better assessment of all Grameen borrowers, irrespective of any loan type that they have availed. So if we say that, okay, rural borrowing might have only microfinance housing loans, whereas might have housing loans specifically, but there could be certain well-to-do or well-off individuals in rural areas that have availed housing loans, that have availed car loans. So they should also be fairly evaluated because they are also, after all, our Grameen borrowers. And third point is the RBI circular that we had received, which also does not restrict to any specific rural or any specific credit types. RBI circular also maintains the same stance that Grameen borrowers as a whole should be assessed better and fairly, and should not, and therefore we conclude that there should not be any filter or restriction on the product types, on the ticket sizes, and on the type of credit institutions that are lending into the geographies that are categorized as rural in nature. Okay, so this was a quick understanding on why all the product types are considered in the model development. Next, we will have a look at the model performance. Like I mentioned earlier, that the model has been developed and tested across different samples or different snapshots that we call in more technical terms. What does that mean? So let's say a model is developed based on a portfolio for a given point in time. So it should hold true for other points of time also in the future. Why is that necessary? Because let's say you incorporate the Grameen credit score in your policy, and let's say you have one or multiple cutoffs for lending to your Grameen borrowers. Then for that score cutoff, you should be able to see that similar proportion of all applications are accepted and rejected over several periods of time in the future. There should not be a great population shift in the approval and the rejection section. And for those population or for those applications that have been approved, an acceptable bad rate should be seen over various points in time. So that is indicated by the stability of model, which is ensured by testing the model across various snapshots. Now I will explain how have we tested the model across different snapshots. So there are mainly three snapshots that we have presented here, which is the development snapshot, means the period, the point in time for which the portfolio was taken to develop the model. The next snapshot is OOT, which is out of time validation. And the next snapshot is ultra out of time validation. UOOT, this is an additional layer of testing that we've done to check the stability of model. Now, how do we test it? So as I mentioned earlier, the model has a score range from 300 to 900. So we divide or classify this score range into 13 tranches, as you can see here, or 13 groups, as you can see here, from A to M. Now A tranche is that population which falls in the best score range, and therefore A tranche comprises the population that are least risk, and similarly tranche M comprises the population that are highest risk. Now when we award a score to the borrowers, we expect that according to the score the proportion of borrowers should go bad, means those borrowers that have got the best score range or the least risk score range, which is A, should, out of these borrowers, the least percentage of borrowers should go 90 plus in the next 12 months, and this percentage would go on increasing as the score range degrades. And finally, those population those borrowers that have been awarded a score range in the category M, from these borrowers maximum possible borrowers should go 90 plus in the next 12 months. So this helps you to weed out the bad customers or separate the bad customers from the good customers by having a score cutoff or a multiple score cutoff strategy. So now the and while distributing the population across these score ranges, we try to evenly distribute the population across each of these tranches at the time of development. Now if you see, around 7.5 to 7.5 to 8% or 7.4 to 8% of the population is evenly distributed across these tranches from A to M. And then we expect that during ultra out of time and out of time validation, there should not be a major population shift amongst these score tranches. So if you see those bar graphs here, the light blue bar graph is the population distribution as of the development sample, the yellow one is as of OOT sample, and the dark blue one is as of ultra OOT sample. So if you see, there is minimal population shift between the blue, yellow, and dark blue bar graphs, which indicates that the population is stable across different points in time. So if you have a score cutoff, let's say at, for example, at 718 or 744, over a period of time, you expect the same approval rate of your applications. There will be no sudden reduction or spike in the approval rates. Now, the next point that I mentioned was the bad rates. So we said that the bad rates should also remain stable, and the bad rate should be higher for higher risk score segments or groups or tranches. So if you see, the line graphs are indicating the bad rates here. So for development sample, for the highest risk tranche, the bad rate is 99.8%, means out of the customer or out of the borrowers that have been awarded a score from 300 to 428, almost all, that is 99.8% of the borrowers have gone 90 plus in the next 12 months. And then that bad rate reduces as the score grade improves. And if you see that for tranche A, then it indicates that only 0.8% of the borrowers that were awarded score from 837 to 900 have gone bad in the next 12 months. Also, there are no breaks or no spikes in the bad rate across this range. So the basic is established that the model offers a strong rank ordering across its tranches. Now, the bad rates, like I said, once you have a score cutoff, you expect an acceptable bad rate that you had estimated earlier from the population that you have approved. So if you see the three line graphs, which is across development, out of time and ultra out of time sample, are almost overlapping each other, which means the bad rates are also stable across different points in time across the groups from M to A. So that ensures stability of the model in two aspects. First, there is no or minimal population shift, no sudden spikes in approvals or rejections, and stable bad rate means no sudden spike in the bad rates of the approved population. Now, while these two basic premises are established for the model that has been developed by CRIF, it is also desirable to accept as many as applications or approve as many applications that you can, but at the same time reject as many potentially bad borrowers that you can or bad applicants that you can. Or in other words, reject as many potentially risky borrowers that you can. So for that, we need to have very high bad rates in the highest risk tranches and then lower bad rates in the following tranches so that you can approve population from more tranches and you can reject population only from 2 to 3 or 4 tranches. That takes care of majority of your bads. So if we consider tranche M, L and K, which are the highest risk tranches or lowest three tranches or worst three tranches, these three tranches, if you total the population, it comes out to around 23%. But the total percentage of bad customers or bad borrowers in these three tranches is 75.2%. So by eliminating 23% of applications, you eliminate up to as high as 75.2% of your bad borrowers. So this again establishes a third premise for the model, indicating that the model has a very, very strong capture rate. So to summarize here, the model is stable in terms of population distribution. The model is stable in terms of bad rates across different spans in time. And the model has a very high capture rate, enabling you to approve more and reject more bad. Okay. And lastly, what I would like to call out here is what is the difference in the score that will be awarded to a borrower between the consumer model and the Grameen model. So suppose for the same borrower at the same point in time, if we generate the existing consumer score as well as the new Grameen credit score that we have developed, what changes do we expect? So here we have prepared a cross tab between the Grameen score and the consumer score. What we have done is for the Grameen population, for the same time as of the development snapshot, we have awarded consumer score as well as Grameen score and then categorize them into those tranches. So the score scaling and range, while the range remains the same for consumer and Grameen score, the scaling is slightly different. So we can mainly focus on the tranches, which is A to M for consumer score and A to M. I'm sorry, I'm audible, right?
Yes, yes.
Yeah, okay. So now, if we see that certain customers are such or certain borrowers are such that have got the same tranche in the consumer score as well as the Grameen score, which is indicated here. So 7.2% of borrowers have got the same M tranche for consumer score and the Grameen score. But 5.8% of the borrowers have got a poor tranche in the consumer score, but a better tranche, that is L, in the Grameen score. Further, 2.2% of the borrowers have got again a worse tranche, or the worst or the highest risk tranche in the consumer score, but again two tranches better in the Grameen score, and so on. Of course, the extreme corners of this matrix, if you see, will be largely zero, because it will not be the case that the consumer score is awarding a tranche of M and the Grameen score is awarding a tranche of A. Such high differences in the consumer score and Grameen score will not exist, because even the consumer score as of today is performing well in the rural geographies. But what additional benefit the Grameen score brings here is that more sharpness and ability to determine better borrowers amongst the rural uh, population as compared to the consumer score. So therefore you see that there are some borrowers that have got a better score or better score range in Grameen as compared to the consumer score. Another example, if we take, let's say, let's consider this tranche J. So 1.5% of the total borrowers are awarded tranche J in the consumer score as well as the Grameen score, but 2.5% of the borrowers are such that have been awarded a better tranche I. Then 1.3% of borrowers have been awarded a better tranche H, and 0.6% borrowers have been awarded a better tranche G in the Grameen model. So you will often see an improvement in the notch for majority of the borrowers uh, in the Grameen model as compared to the consumer model. So what we've done in the table here is that we have we have identified what percentage of population has equal score in in the Grameen model as well as the consumer model. What percentage of borrowers have a better Grameen model grade as compared to the existing consumer bureau model grade, and what percentage of borrowers has a better existing consumer model better grade as compared to the Grameen model grade. So if you total this better improvement in Grameen grade as compared to or Grameen model tranche as compared to consumer model tranche, it comes out to around 53%, which is much larger than those set of borrowers which have got a better existing consumer uh, score grade as compared to the Grameen grade. So what does this indicate? This indicates that the Grameen score model is able to find out better borrowers from the rural population as compared to the existing consumer score. And for a majority of borrowers, you expect that the better risk tranche will be awarded by the Grameen scoring model. And what does that mean? It will help improve approval rates for the rural population with the help of Grameen model. In other words, it will help disburse the funds to needy or as per need to the Grameen population, and therefore also suffice the premise or the goal of financial inclusion in the rural borrowers. So this is where what the vision of the government and RBI was, to be to have an ability to better disburse funds to those who need it the most in the rural areas, and Grameen score will rightly help meet that vision of the government and RBI and the overall lending industry. Another point again to re-establish the fact is that if you see the population of the best four tranches here that Grameen score has awarded, it comes to around 31%. Whereas if you sum up the for the same Grameen population, if you sum up the population of the best four tranches, that is A to D for Grameen population, it comes to around 25% or to 26%. So there is a 5% plus lift itself in the best tranches itself. So this again re-establishes the fact that the Grameen score will help improve the accessibility of credit in the hands of the rural borrowers, and thereby meet the vision as mentioned by the government and RBI and the overall lending industry to help disburse more and better to the right rural borrowers. So that is all for the presentation from my side today. I would thank you all again for patiently listening, and we would be happy to take questions now, if any.
Hi, Sadaf, this side. I just want to have a quick question. If you can pull that slide where consumer score and Grameen score were together. Yeah.
Okay. Yes.
Yeah. So, is it safe or to assume that the Grameen score is slightly more stricter than the consumer score? Because if I see the score band from 570 to 642 in the consumer score, the delinquency or the bad rate is zero almost. And for the same, I think if we look at the score for Grameen, it is 682.
Sorry, which is the tranche that you mentioned for consumer score?
Yeah,
571 to
571 to
642.
642.
Okay. So these are not bad rates. These are population distribution percentages that we have mentioned here.
Yeah, so okay, is there a correlation between bad rates of these or the consumer and the Grameen? Because what I see in Grameen, even if we look at 680 plus, it's improving. Below 680, the credit behavior, the bad rates are higher. And whereas in the normal scenario, we see that around in the consumer score, anything above 600 is good.
So yes, I will explain that with the help of this chart because this indicates bad rate. So if you overlay the consumer score on this and compare the bad rates, we see that while the consumer score also rank orders and it captures risk, but this is much more sharper. What I mean by that, the bad rates, if you say, would be slightly lower than that of the Grameen score model, and the bad rates for
No, no, I'm not questioning that. I'm just saying purely the score number that we need to look at is 680 plus in Grameen score for
So
a
that at a generic level, it will be difficult to comment. What we do is we post the webinar or post such initial presentations. We perform a POC with the given credit institution on their specific portfolio
no, no.
because
I'm not
portfolio
looking
differs.
at the whole my portfolio. I'm just looking at the. Can you go to the previous slide where the comparison is there? Yeah, in that this 600 band 600 to 681 is where the decline is there, and 682 is really the score where things are improving. But 680 for a consumer score is a very, very high score.
Hmm. So again, I mean, I would not comment on that because it could differ from organizing CI to CI. Generalizing it may not be apt at this stage for if you look at the results for the entire industry, and
Yeah.
it differs from one CI to the other. So 682 may be a good score for one institution but may not be for other. So it will be difficult for me to comment at this stage looking at the overall industry results.
Yeah, see, traditionally the credit policy is made based on the score, not a CI based score. So it's from that context I'm talking. And why did you cut across 13 kind of a vertical? Usually it is cut across 10.
Hmm.
So why did
So
you
that
cut
is a
the
usual
data
trend.
into 13
Yeah,
pillars?
correct, correct. So when we cut across 10, we call it deciles, wherein approximately 10% population is seen. But it has been a mechanism or a methodology at CRIF globally to have 13 tranches. And the reason is that we are able to provide more separation in the bad rates across 13 tranches as compared to 10 tranches. Especially for the mid-risk segment, you need to have more separation in the mid-risk segment, I would say, because that is where the onus lies more on the credit institution to take a decision. Because mid-risk segment says neither good nor bad, and you do further due diligence. So what the methodology has been to have more finer buckets as far as possible. Of course, there could have been 20 tranches as well, but then going that fine does not yield the required results. So after some research, they have arrived at globally we've arrived at 13 tranches. The basic idea is to provide more granularity.
And bad rate is defined here as 90 plus.
That's right.
Fair enough. Okay, thank you.
Yep. Thank you.
Sahil, just a question from my side.
Yes, sir.
For this Grameen score, what is the kind of population you have taken, and what was the vintage of those population?
Yeah, so we have taken population of only the rural geographies, rural pin codes, and I mean pin codes as per government data. Uh, so entire a sample, I mean, in any model development and validation exercise, we take a representative sample. So a representative sample of entire rural population across India has been taken. And uh, the repayment, your next question was regarding repayment behavior. So up to 36 months of repayment history is taken to generate the score,
So,
and of course to develop and test the model as well.
if I understand correctly, you are saying that up to 36 months credit history of this population has been examined.
That's
studied.
right. That's
And what
right.
size of that population? That's what I was asking. Something like 1,000
Around
to.
sample size is around 28 to 30 lakhs.
Mhm. Okay. 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 Thank
And
you.
Gigi sir,
Hi,
just to answer on your vintage question. So what vintage we have considered while developing this model? So it's a mix of the vintage. So the vintage you can consider more than 48 months also, and the vintage you can consider less than 48 months. So it's a mix of the vintage, the borrower, the sample which we have considered. It's a mix of all the vintages.
Okay.
So
But
I'm
there
sorry, just one more point. I also would like to introduce Mr. Ashish Srivastava, who heads the uh, MFI lending and rural lending space here. He is joined here, who just answered, and we also have Mr. Abhishek Gupta, who's from the sales team, who heads the North region.
Thank you.
I
Yeah, from
have a question. Anybody wants to ask question?
Yeah,
I think
hi.
MD sir from Cash.
Okay, please go ahead.
Yeah, this is Kaushik from MD office, Cashpa. Sahil, I have just question. Can you go to the last slide, please?
Yes.
Uh, yeah, on this slide, you have mentioned that these are the proportions, right? The distribution of consumers according to the consumer score on the horizontal line and the Grameen score on the vertical line, right? Uh, do you have any data of the delinquency in these buckets as well, so that what Sadaf sir is saying, so that
Yes.
can ascertain whether the Grameen score is more accepting or harsh than the consumer score? Well,
Yes, yes. We do have that, and we'll be happy to discuss those stats with you separately after the webinar.
okay, okay, sure, sir. That
Those
was
are
fine.
readily available with us. Yes.
Thank you for that.
Good afternoon, all. Hi, Sahil.
Yes, sir. Hi. Good afternoon.
Yeah, this is Manoj from Worthridge. And, while algorithms and data are the hard part of credit assessment, the Grameen or our rural geography has a lot of soft part also. So I need to understand, how you have taken care of the soft part, which basically blindsides most of the credit decision, as my experience says. Number one is 33% of the rural credit is shop credit. Shop credit is something which the shop provides to the individual homes, and this data are neither captured nor it gets reported. So that is one. And obviously, there are a lot of other sources, it is relatives and friends, money lender. While you might say that this is universal and it is applicable for all, but these nuances makes a lot of changes and alterations in the rural market. Number two, talking about your population and the sample data, uh, as we are in community lending, there are a lot of community practices which varies from Rajasthan to Kerala. So, what are these nuances and how does the rural credit score gets to incorporate them? And does it consider one is, gender, because all along MFI has been serving the female population and they are assumed to be a better repayment borrower than the male gender. I'm assuming. Second one, have you run it through a individual and a group level lender to understand the difference whether any variation comes when a person is in a group or an individual? Because these are the basic core of GLG and SHG lending. So has these been incorporated? And obviously, I'm not getting into a lot of other credit providers in the rural area. It could be chit fund, it could be, a Nidhi company, and so on and so forth. So while we get a picture in terms of the data you run for the last 36 months, how we can afford to not get blindsided by these particular factors?
Okay. I
Sahil, can
think,
I take this
yeah,
at
sure.
first place? Okay. Hi, sir. So you have rightly raised these questions. So first of all, on the softer part, you have just mentioned. So, sir, the model which we have developed as of now, this is the phase one as per regulator also. And if you look at the model development, whatever we have considered only the information which has been reported to the credit bureau. So this is purely based on the reported information to us. This is one. Second, on the SHG's piece that you were mentioning about this community funding. So if you look at the announcement of Minister, actually the Grameen score was more focused for the SHG borrowers only. Because as of now, if you look at the individual borrower, be it in rural or urban, they are eligible for getting any kind of score. But for the SHG borrower, if you look at if they have borrowed only from the group, they are not visible in the credit bureau ecosystem. Why? Because these data are not digitized at bank level. So if I may give you a statistics on SHG level, so as per NRLM, if you look at the currently there are around 10 crore unique borrowers, active borrowers are available in the SHG space who have availed loan from the group itself. But if you look at the credit bureau's database, do credit bureau's database have the information of about borrower demographic information, but they don't have the performance of the borrower. So let's say if a SHG has availed 5 lakh loan from the bank, but bank will not be knowing like how much has been distributed among all the SHG borrowers. So we do not have like a specific borrower has availed, let's say 50,000 or 60,000 from the SHG, and we do not have performance. So in the absence of this information, we cannot include these loan performance in the model itself. Even this has been communicated to regulator also. So they said that as of now, whatever is available with us, we can go ahead and create the model as a phase one. So this Grameen model is a phase one model. And
Right.
in some, after some time, let's say if we do get all these information, definitely we will incorporate this information in our model.
Right. Thanks, Ashish. My actually, basically the awareness question was these nuances of rural geography is very different from urban, and
Correct,
if
sir.
we don't incorporate these, we will be just creating a clone of consumer assessment system, and it will not really be very, because precision is now the real way forward for rural credit, and that can only happen if you have more such granularities incorporated into it, and hopefully in phase 2 and 3 we will be able to see it. Thank
You
you.
are absolutely right, sir. Thank you, sir.
Yeah, this is Mukesh Singh from Utkarsh SMB. So my question is, what kind of loan has considered for this score in a rural perspective? Is it microfinance loan, personal loan, business loan? What kind of loan?
So yeah, so there was a slide on that. We have considered all product types. That includes all personal loans, credit cards, car loans, housing loans, etc., as well as those assumed to be more rural in nature, such as KCC, tractor, agri loans, as well as MFI loans. So all product types have been included in the development of this model.
Next slide again.
Okay, okay.
Yeah. So we also saw why we arrived at that conclusion. We saw three reasons mainly. We see that those presumed loan types that are assumed to be only and only rural in nature are also having presence in the urban geographies, and vice versa. Those product types or loan types that are believed to be more urban in nature also have rural presence. And the next two reasons that we discussed were the union budget announcement does not restrict to any loan type or product type, and so does the RBI circular.
Okay, thank you, Sayed.
Achha, I have one point, Sahil. We are taking the data of various products, various loan products, you said.
Hmm.
So unless they have a uniform identification, will it be, I mean, will it be possible to arrive at this kind of a score?
So
That's also my question.
So you mean that there should be a ID such as a PAN or a voter ID card that has to be reported to the.
Two-wheeler loan, tractor loan, the KCC loan. All this loan, if it has to be taken into, factored into, it has to be all based on a same ID. Otherwise,
Unique ID.
it may be difficult.
Correct. So there is something called search and match algorithm at our CIC, which uniquely identifies the loans belonging to a particular individual or a borrower. And yes, ID is a very important factor that is considered. But we are able to, so there should be, let's say there is a loan wherein a voter ID is reported, there is another loan wherein a PAN card is reported, there is a third loan where UID is reported, and so on. But there are certain things common between these trade lines still, such as there is a high match between the name, the address, the date of birth, the phone number, and so on. So even if all the loans do not have the same ID reported, if there are common linkages between those loans, our search and match algorithm accurately identifies the loans belonging to a borrower and gives the credit report along with the score.
Right. One more question from my side is that how are we treating the new to credit? Because this we are talking about somebody who is already in the credit bureau ecosystem and they have some data behind them. How do we?
Right, sir. For new to credit, if there is no credit data available, as a part of phase one, we will not be able to score them under the Grameen credit score model. As a part of phase two, like Ashish also mentioned earlier, we are in discussions with the regulator about what other attributes can be included and can be reported to the CIC. So if we finalize, if RBI confirms on those attributes which are of non-credit in nature, we would be including those, and maybe in phase two or phase three, the problem of new to credit can be solved. But as a part of phase one, new to credit will not generate a score.
Right.
Sahil, I have a question. Like in this slide, you are writing that 75.2% bad captured in the lowest three tranches. So what is this three tranches? Lowest three tranches?
Lowest means lowest score tranches, which is M,
Okay.
L, K.
Okay. Score tranches.
You add 7.6 plus 7.8 plus 7.6, it will give around 23%.
Okay, and like score tranches was not there, so I was thinking that what exactly is it? And when we are discussing about this your vintage, is there any guideline from RBI that how many quarter or how many months you need to consider to to analyze the score? Is there any policy guideline?
No, there is no fixed guideline or rule to on either on the vintage or on the repayment history.
Okay.
So we have, I mean, for vintage, there is no restriction. Any, like Ashish also mentioned earlier, there is a mix of borrowers with less than 48 months of vintage and greater than 48 months of vintage. And
Got it.
also on repayment history, there is no specific guideline, but we've seen it's a best practice globally as well to consider up to last 36 months of repayment history, and that yields the best model results.
Okay. Okay. Thank you.
Yes, sir.
Sahil, one more thing.
Yes, sir.
You are saying that you currently do not have any data for this new to customers,
Hmm.
new to credit customers.
Correct, sir.
That's right. If a customer do not have applied for any loan, there
Hmm.
won't be any history. Now, suppose say I have a KYC with the number 1234, and I have availed loans, 2, 3 loans, and then the next time if I have applied with a fake KYC, I'm using this word, a fake,
Hmm.
deliberately, because I intentionally used a wrong KYC ID, maybe 5678,
Hmm.
then there won't be any history on that 5678. All right. So would it be considered as new to credit?
So, sir, that is also dependent on other inquiry parameters that have been provided.
I agree. I agree. I agree.
The name, the date of birth, the address, the phone number. Also, the relationship name is received sometimes, such as husband name, father's name, etc. So, if there is a match found as a combination of other parameters, you will still get. But if, let's say, multiple parameters have been changed, the
I'll tell
name.
you, I cannot change my date of birth. Yes.
Hmm.
Uh, Sometimes the name, the spellings are different in one KYC to other
That is
KYC.
taken care of. Spellings are taken care of.
Right.
Yeah.
So if I am deliberately doing a mistake, I
Hmm.
can do it in multiple times, multiple
Hmm.
parameters.
Hmm.
So my question is there any validation with the bureau that whether the KYC is submitted is valid or not?
Hmm. So,
Is there
sir,
a validation?
yeah, I mean, CICs are not as a permissible line of business as per CRIF Act. CICs are not allowed to refer to any other source of validation. Let's say I'm trying to validate voter ID as per electoral records or PAN as per NSDL records, and trying to identify whether this PAN exists or not, or whether the name matches or not. Such external sources, even if controlled by the government, cannot be used by CICs to verify the PAN or voter ID or any other ID. So that is a restriction as per the SICRA Act that we are bound with, and we will not be able to verify whether the ID exists or whether the ID matches the name as that provided in the inquiry.
Got it. Got it. The output is based on the input only.
Correct, sir.
Absolutely input. If
If
input
there
is
is a
incorrect, the
deliberate.
output is be incorrect.
Yes, yes. So if there is a deliberate tampering of IDs and multiple other inquiry parameters, then we cannot be sure of the kind of credit report or credit data generated and the score generated.
Got it.
Any other questions?
Thanks.
Okay, great. I think it was wonderful, Sahil. It was really great insight to all of us about this.
Thank you, sir.
So, shall we close the meeting? Hmm? So, thank you everyone for joining this webinar, and really thank CRIF Highmark team, Ashish, Sahil, and the team who have joined, given us all the information. I think it's a very welcome thing, and I find that your model looks to be a little more elaborate in the exercise of coming to the scoring model, and hope that this will really help boost the credit. Of course, as we go forward, I'm sure things will become better only because more and more information additional features, new to credit assessment, SSG data being brought in. So all these things will definitely going to make it much more stronger and better, and that will help the rural folks to avail the credit from the banking system much more easily. So thank you so much, and we look forward to see how it pans out. And for the information of all the MFI people sitting here in the webinar, there is a clear-cut guidelines from the RBI which says that MFI, not only MFI, every financial institution should start taking Grameen credit score also as part of their assessment, credit assessment part. So kindly take note of that. Thank you.
Okay, thank
Thank
you
you,
again,
sir.
sir. I would express my gratitude to all Sa-Dhan members and all other members from the industry that have joined. Thank you very much.
Thank you. Great.
Thank you.